Hello, Glenn.
Hey, how are you?
I'm so excited to have you on the podcast. I want to start off by giving you an introduction. Glen James, you are a now retired, multiple award-winning financial advisor. You've got experience helping countless people get on top of their finances. You're the host of the award-winning M3 Money Podcast Network. You've built a career helping Aussies feel confident with their money, but your own investing journey has been far from textbook. You have released a number of best-selling books, the most recent being the Quick Start Guide to Investing, which has done incredibly well. So we're excited to have you on the show to help us learn a little bit more about investing 202, more advanced investing for the person that goes, look, Sim, I know what an index fund is. I don't want to be explained what an ETF stands for anymore. Let's get into the more nitty gritty. So thank you for joining.
My pleasure. It's so great to be here.
I want to start off by saying thank you for letting us come and record in your studio. And the first question that was asked for you was not to start you off too much in the deep end, but should long-term investors try to time macro or micro cycles or just ride them out?
I think by definition, if you are a long-term investor, you're not riding out micro cycles. It's funny, I saw online somewhere the other day, I don't know where it was, where it's like companies might not be forever, but indexes might be forever, and they are forever. And for my own investing journey, I've really decided and resolved that I'm okay with market returns. Now, there's a couple of things in my own financial life that I need to achieve in terms of investing, and that is we want an investment rate that's higher than cash and beating inflation. So I want a real return. And if I set up my financials correctly and what I spend each week and what I project to live off when I'm older, and if I don't have an active income, I think we need to be okay with market returns. And that being said, how do I get market returns? Well, I keep it simple. And I know you wanted to do a 202, but the more I've been doing this, the more I look for less complexity. So you remember the Dunning-Kruger effect? So you start off, you do all this complex stuff and you want to optimize. And then as time goes on, you realize you don't know what the hell is going on.
And no one does.
And no one does. And it was even yesterday I got a phone call because I've got investment properties. Friends always call you like, what should I do? And they call me and say, oh, we're looking at an investment property. Like they'll write there outside the open home. And they're like, should we buy it? I'm like, I've got multiple properties, but I don't know. I just don't know. If I buy another property for an investment, I'm going to get a buyer's advocate who knows the data, who knows. So I think what I'm saying is for most of your money, it needs to be boring. It needs to be long-term view. But hey, there could be a percentage of your portfolio. You might carve off 10% for your own side quests because that keeps you engaged.
I like that. I think it was Charlie Munger that said investing should be as boring as watching paint dry. The idea that it shouldn't be something that you are constantly looking into the markets with. And I think you answered that very well. It kind of leads me to the next question, which is when it comes to making a portfolio and trying to diversify everything, people go, okay, when you start off investing, you get told don't put all your eggs in one basket, don't buy just, one stock and put all your money into that one particular company. Is there such thing as too much diversification?
Oh, it's actually, I saw something yesterday. So number one, we know that if we had 10 companies and we had $10,000 and we had $1,000 in each company.
10 companies, $10,000, $1,000 in each company.
So equally weighted. If one of those companies failed and you lost all of your money, right? That's still annoying, 10% loss that's never going to come back. However, that's not catastrophic. You can recover. Now, if we go and have a look, the next thing, well, what if we put $10,000 in one company? Sure, that company could go to the moon. You might have a unicorn. It might, be a 10-bagger. It might go to town. But the problem is the downside risk. Now, what if that one company that you put your money in was the 100% of your $10,000, if that failed, that's catastrophe for your situation. It's funny, when you look at the S&P 500 at the moment, I think over, you probably know more than me, like 33, 34% of it is like the Mag 7 or like
the Magnificent Seven.
Yeah, like the big concentration. That's, when you look at it, not that diversified.
No.
And you, maybe over the last 12 months, you may have been rewarded 20%. I don't know when you're putting this up, but we're recording this mid-October. But if you looked at the comparison between the weighted S&P 500 and the non-weighted almost, and we can explain what that is for those who don't know, the one that equally put your money across the 500 companies maybe only did 11% last year, but the weighted version, so you'll put $10,000 in, you'll get, I don't know, $2,000 of NVIDIA or whatever that is. The one that has less diversification and more concentration did better than the equal one. So before we press go on this recording, we were talking about a topic, and both things can be the same at the same time, or there can be two things present at the same time, right?
Yeah.
So I think it's a case of diversification, I think, in my financial life is a must. But the one thing, because it speaks to your appetite for risk, right? And one thing that lowers somebody's perceived risk is education. So there could be someone listening to your podcast who, when they first joined you or read the book, and I believe Friends That Invest is relaunched, the book.
It has relaunched.
So you can get that wherever good books are sold.
Someone put a story up and they tagged me and they bought a Friends That Invest physical copy. It's available in Turkey. I haven't got the book yet. My book is stuck in customs. So it is for sale before I have seen it.
Yeah. So if someone is at the start of their journey, they could be told from someone in their life that buying shares is like gambling. Now, okay, that's a scary statement. And the education goes, well, hang on, if I want to buy shares in Apple or Microsoft, I'm buying a company. Or then you go one step further. If I want to buy an index, I'm buying a basket of companies. So I actually think with education and understanding, investing in an index is actually quite safe.
What we see comes up a lot is sometimes people will ask, well, Glenn, I hear you, and that's really helpful. What if I have kind of overshot and bought too many, or how many is too many index funds, or how many is too many, and I'm starting to see that maybe there's some overlap. Like how do I sit down and go, let's cut back? How many is too many?
Yeah, so I think there's a couple of things happening, and Warren Buffett, the most successful investor in the world, you talk about the diversification. He's not very diversified most of the time. I think before he sold Apple last year, it was 50% of his portfolio.
Oh, wow.
Did very well from it, but he's a freak and, we can just admire from afar. But for most of us, so I think, are you talking about overlap?
Yes.
Yes. I think any type of portfolio, and if you want to have a look at portfolios, have a look at your pre-mixed portion in your KiwiSaver, your Roth accounts, your 401ks, your superannuation, and have a look at the portfolios that are a portfolio in a box. Have a look at the one-stop shops from Vanguards and the beta shares in Australia. I'm sure BlackRock may have some stateside. One of the things is we want to make sure that if there is a downturn with our growth or equity stocks, there is a portion of the portfolio that is there to smooth out the ride that does not correlate. Now, I'm not a believer personally in having a investing portfolio that is 100% growth because I want a smooth ride for the journey. And the problem is if we have, and I will get to your overlap question, if we have a portfolio that is 100% growth, huge concentration, the sawtooth, like zigzag going up a hill or, you're walking a yo-yo up a hill, when you've got such a concentrated portfolio, that walking a yo-yo up a hill, the hill's going to be steeper and the yo-yo is going to be going up more and more. Because we're humans, if we see that, we've got more of a chance of freaking out and wanting to sell and get off the roller coaster. where I've resolved in my life. Remember at the start I said, I'm happy with market returns above cash and above inflation. And I want buffer, and if I get more at the end of the journey, awesome. If not, awesome.
Mm-hmm.
Now, I do take some risks with some other things, but I don't put my lion's share in that. Now, when it comes to overlap, sure, you probably simplistically, if you had an S&P 500 ETF, if you have a NASDAQ ETF, those two ETFs, you're going to have a lot of overlap. One's not needed. I personally don't invest in the top 100 NASDAQ alone because I think I can get that from the S&P 500. It's because I'll take risks, and I'm actually a conservative investor because I don't have 100% growth.
That surprises me.
Yeah.
I wouldn't have expected that.
Well, I've been around the block long enough that I was, when the GFC hit, I was working in a financial planning office. I'm that old. I've seen the shat hit the fan. And there's a lot of us out there, if you're under 30, if you're under 35, you've not lived through a really crazy prolonged crisis. COVID, we had a V-shaped recovery.
Yeah. It was like 3 months.
The Trump tariff crash, that was 10 minutes.
Yeah.
So we have to always go back to the fundamentals. When it comes to religion and politics, fundamentalism is really bad. But with investing,
it's the one time we allow it.
It's the one time we allow it. So the fundamentals, if we've got money to invest for the future, we don't want to put that to work if we need that cash within 3 to 5 years. It's okay to have a savings account. The fundamentals, markets go up and down. We need to not react out of fear, not try and time the market. But yeah, if you do have multiple ETFs, I think there is an argument to simplify. My retirement account, I've got a self-managed retirement account, and I just pay a company, Life Sherpa Invest. You've met Vince, have
yes,
you?
I have, yeah.
So he's got company portfolios. I just invest in there because what it does is there's a portfolio that's got a long track record. It's made up of different ETFs, and you can go on the website and see the funds they use. You could do it yourself, but this is where the behavior comes into it. I have, and I pay a small fee for that, but what it means is every 3 months come hell or high water or whatever, it's going to be rebalanced. So we're going to sell from some winners, put it back into conservative.
So you're basically saying, let's say company A does really, 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 really well. You're not going to continue to hold that and go, well, let's just ride this to the moon. You are happy with that return, and you come back down to a more safer baseline.
Yeah, and I think that's the whole thing. Like, investing works, us people don't.
Yeah. Oh, I like that.
Yeah.
What do you mean by that for someone? Like, do you have an example or a story with that?
Yeah, I mean,
You probably have a few.
In our Facebook group, we had someone write the other day, like, oh, things are getting crazy at the moment. I've just moved all my money to cash.
Ooh.
And I'm like, okay, I'll buy it. Peter Lynch, one of the most successful investors, said more money has been lost by people trying to time the market around a correction than the actual correction itself.
Yeah.
And
Peter Lynch is a growth investor. So that's coming from someone who is into taking risks.
Yeah. And I would say as well, I like money like the next person. I'm not allergic to it. More is more when it comes to money, right? But when you said if you had a company A and the company A went really well, the bias, do you have the stomach to sell a winner and to rebalance? I don't know. And that's why for me, I like to focus on my day job and my business, and just my focus in my life is to shovel as much money into my investing accounts as possible. It's auto rebalanced. It's just taken care of. Sure, I've got an account that I go on side quests and, do all that quote unquote fun stuff, which us nerds think is fun. Have a look at that. But yeah, I think for the main, we need to really get educated and really understand that market cycles will go up and down. But know that we have to remove our own bias and emotions from that investing.
I think that is such a great answer. And I want to dive a little bit more into you talking about having the main portfolio and then your fund or satellite portfolio. How much would you, I mean, I know you can't recommend, but for someone listening who, at this stage knows what an ETF is, usually knows the jargon, how much is a good amount to have as that fund play money to take punts, but still look after yourself?
Yeah. So, okay, you've just opened such a Pandora's box. I was thinking the other day, what does that actually mean? Who was Pandora?
So
like the bracelet shop? Did she have a box?
Oh, come on. It's Greek mythology, right? Isn't it?
Oh, yeah.
And there's like a box and they get told, I mean, I learnt this when I was in primary school, so I might be completely wrong. But there was a Greek mythology where they were told, like, don't open this box. There's things in this box. And the kids were like, oh, let me just have a little peek. And they opened it and all these ghosts and things came out.
Yeah.
And it's that like curiosity sometimes wins, but bad stuff happens from curiosity.
Curiosity wins, but at what cost?
Yes.
Right. So the Pandora's box there is like what percentage do you have as your side quest money, or I'm genuinely interested in buying single stocks. And we know the data, the empirical data says that people who try and trade and buy and sell shares will do worse off over the long term. It's a famous study from Berkeley University. Trading is hazardous to your wealth.
Mm-hmm.
It's the data, right?
It's a great study.
What I would say is if you deviate from the market or broad-based indexes, right?
Mm-hmm.
If you deviate from there, you'll get a different result. Now, that different result could be good or could be bad, but you're going to get a different result. There's a question there with like ethical investing. You have to be benchmark unaware because you might not think NVIDIA and Facebook is ethical, so you're not investing. So you will get a different result. You may have to pay more and you may get a lesser return, but you've got a different result and you know about it. And you're happy to lie in the bed you make. When it comes to strictly fun money, if you want to call it that, I think there's two pots. If we had a portfolio, and we'll call it 100% of our money in a portfolio, there's that general concept of core and satellite approach, right?
Yeah.
So when I was a financial advisor, we might have a 80% core portfolio and then with 10% little pots in some satellites to get some either extra concentration to a sector or something completely different.
Oh, I like it.
So I think there is that maybe 80-10.
Yeah.
It could be I might have a retiree client who needs income. We've got an 80% core and a 20% in dividend shares. So it's producing income. Sure, there could be some overlap there, but it's on purpose. We know what it's about, blah, blah, blah.
Yeah.
Now, that's, I think, different. And I'm talking core and satellite under the guise of core broad-based index. Satellite could still be a diversified fund that invests in green energy only.
So it's not just 80% index funds and then 20% in one AI company.
No.
And that's
No. So that's this. For me, I'm probably not doing more than 90-10 if I'm going to do direct equities.
Yeah.
I've got my core 90% over here, 10% I'm going to, invest in that, or because it's all about we don't want to get flushed. And if you have a think about it, years ago, I invested in an IPO, initial public offering. A company was being listed on the exchange. I put $10,000 into this IPO and that was fine. That was good. It listed. It did 600% return in 2 weeks. I called that a smash and grab. Got my profit and got the hell out of there. Mm-hmm. Okay.
Was it Oatly?
No. I'll tell you later. Now, this is interesting, and I want everyone to think about in their own life. If you had $10,000 and it went up to 50,000 to 60,000, like 5-6x, right? That's a lot of money. It could be life-changing, but over the scheme of your life, if you're earning 100 grand a year, 80 grand a year, it's nice, I'll take it, but it's not wow, life-changing.
It's not, hey, boss, don't ever call me again, I'm leaving.
That's right. Now, so I put $10,000 in there, which if it didn't do anything, and this is similar to when you talk about venture capital and all that, I was never, knowing what I know about investing, knowing about my own personal situation, I was not putting $100,000 in. I was not putting $200,000 in. Sure, if I sold everything, put $1 million in that, and then it went to 6 million, awesome.
You're not hear from me again.
That's life-changing money. But the downside will flush you.
Yeah.
Where we need to go back to, we have to get to a place with our investing, I believe, where we're not doing it for our life to be changed right now. We're doing it to have a dignified future with options. We want the life change right now. We need to somehow get into a career and a job that we don't hate, that we like, that we have purpose. Then we just put money into our investing. The minute you start to get greedy with your investing and desperate, do you know what follows? Broke. All day long. So I don't know if that answered your question, but maybe 80-20 if you are doing some diversified satellites, and maybe 90-10 if you want to do direct equities.
I really like that. I think it is something that a lot of investors, you kind of have like, it feels like a stepping stone. You first learn about index funds and ETFs, then you go, oh, there's also these individual companies, like let me take a punt.
Yeah. And
especially in a market like this where there's a saying, I heard someone say that even a golden retriever right now could like make a return in the market because right now everything's going up.
Yeah.
And so then you start getting a little bit confident. You're like, well, maybe I'm really good at this. How do you bring yourself back down to reality before the market does that for you?
I think it's just time and experience. And, there'll be people listening like, yeah, that's cute, Glenn, 80-20, that's nice, or 90-10. But I'm, 100% of my portfolio is in NVIDIA because I'm going to town. I'm like,
diamond hands.
Yeah, sure. Knock yourself out. Because remember, you deviate from the benchmark, from the markets, you'll get a different result.
Yeah.
Could be good, could be bad. It will be different. We know that much. For my life, I've just had enough experience, and it just comes with being around longer. You're a fossil, you've seen a lot, right?
You're not, okay, sure, yeah.
I think my only encouragement would be to people, focus on what you're good at in life. That's your day job. And just save up. My financial plan for my own life is very simple. Give some, save some, and that's invest, and then spend some. It's very fundamental. I don't like fundamentals with other crap, but with money and investing, it's really easy to be fundamental.
Give some, save some,
spend some.
Spend some.
Because then I'm always being generous.
Yeah.
Which I think is very important. If you can't afford to be generous at the moment, you can afford to give blood. It's free. You can give a smile. You can make some food for a neighbor.
Yeah.
I think generosity is really good. It keeps you
grounded.
Keep you grounded.
And you can be generous with your time.
That's right.
Yeah.
Now, with the save sum, for me, and I'm Glenn, I'm a recovering spender, the save sum guarantees that I'm always living on less than what I earn. And I don't do consumer debt, anything like that. I don't have a car loan. I'm trying to be really like, give some, save some, spend some. Because, we wrote the book, Sort Your Career Out and Make More Money, as the prequel to my first book. Because if you nail your career, that will be the best financial return in your life. Because if you think, if you got to, let's play a mental exercise. If you had $10,000 and you wanted to double that to $20,000 with investing, you'd have to hang around in some high risk investments. And the chances of that doing 100% in 1 year, good luck, it's crazy, won't happen. But what if you dialed into your career and got a $5,000 pay rise, $10,000 pay rise, that $10,000 pay rise, that's the same every year, if not more. It stays, and you don't have to be hanging around high risk ventures to get that.
Tell me if I'm wrong, but it's almost like you're saying maybe we need to bring down the level of risk in your investment portfolio by trying to pick these 10 baggers, these winners, and instead increase the effort into our careers with making more money. How does someone even begin that process? Like, I know you've got This Is Work, the podcast. Is that like a good place to get started?
I actually think the best place to get started is to do an honest check of yourself. Are you investing at the moment to change your life as soon as possible? Because if the answer is yes, you might get disappointed.
The answer is yes.
Because, like, this is so crazy. You know, we talk about the FIRE movement and retire early and all that. The amount of capital that you need to get to retire early, that capital's, for the most part, not coming from investment returns. It's coming from your own savings.
Yep, absolutely. That's been the case in my journey, at least.
So I say to people, the first thing that you can do is ask yourself, do you like Mondays? Do you like what you do? If you don't, it might not be able to be changed right now, but let's put a plan in place to see if we can change. And if that means, like if you're in your 20s and you don't like your situation with work, with your living situation, with your relationship, I would really encourage you to stop putting that $1,000 or $500 a month into investing accounts. Let's save some cash up, whether we need to restudy, whether we need to save enough cash to leave a relationship, whether we need to save enough cash to do something. Because once you are content and you don't hate life, the money will sort itself out.
Oh, I like that. I've not heard that before.
Yeah. Mondays don't suck, your life sucks. And that's really offensive.
Yeah.
And another thing that you can do as well is write down what is your definition of success. And I think for most people, there will be people like, I want a $10 million portfolio, I want this.
That would be nice.
Yeah. My definition of success, which I've met, is not needing an alarm clock for most of my life. And I've done it.
Do you naturally wake up early or you just...
I just wake up whenever.
What time did you wake? You woke up early today.
Yeah. I think I woke up at like 7:30 this morning, naturally. And you were coming at 9.
Yeah.
In my life, I don't book in any recordings before 11 a.m.
Or meetings.
Or meetings, yeah. Like sometimes I do and sometimes I will have to set an alarm. But for the most part, I wanted a life where I've got a philosophy, loot life on own terms. I just wanted to live my life on my own terms.
Yeah.
And the money will work itself out.
I
But
like that.
also, I'm not living on more than I earn. I'm being generous. It's very fundamental.
Yeah. That makes sense. When I think about my own definition of success, I think for me it was being able to be in control of my day. So I guess very similar.
Yeah.
But rather than the alarm, it was if I want to get up and go out of my house and just go for a walk, I want to be able to do that without being tied to something. And it kind of makes me wonder, when people talk about investing, there is such people will say, like, I just want to get the best return and whatever it takes, like, oh, I need to take a more riskier approach. I'll do it to reach that return. And another question that comes up is on margin investing, because that is, taking a loan, investing that money. What should people consider if that's something that's on their mind?
Yeah, particularly in Australia at the moment, there's a big thing around internally geared funds.
Internally geared funds.
Yeah, so the ETF or the managed fund borrows money and invests.
Okay.
Really not fun idea when we're at all-time highs. What could go wrong? Let's look at it this way. And I can speak because I'm in Australia, if you had a house with a mortgage, right, and you had a $500,000 mortgage, right, and you received a $500,000 inheritance, it'd be like, oh, let's invest that $500,000 in the share market.
Mm-hmm.
Awesome. Good thing to do, right? But we've got a $500,000 debt. So what we could do, we could pay down the mortgage of $500,000 and then set up another mortgage of $500,000 and then invest that.
Oh, I see.
And then at least that debt that we already had is now tax deductible. So in terms of strategy like that, it's not a bad thing. But I think for the most part, we just need to break it all down. And all I do the Glen of tomorrow a favor today. And I'm not investing for my life to be better. I'm just parking money for the future, knowing that along the way I've been generous, I've looked after me, I've lived life, and my future is good. And I'm doing something that I like doing. And anyone, like, I've been vocal on my podcast. I take medication for depression and anxiety. At the worst times in my life, if $2 million rocked up in my bank account, weirdly, it wouldn't have fixed what was going on.
I was listening to a podcast.
I mean, it would be nice, but like it's just that rock bottom. Like, who are you? What are you doing? What do you want to do? How do you want to live your life?
It reminds me of this podcast I was listening to by, I always get his surname wrong, Morgan Housel. He wrote Psychology of Money.
Yeah, great.
Great. I love everything he says. And he was sharing how, people say money can buy happiness. And he said, in some varying levels, yes, of course. But if you had to choose between being someone that was depressed and lived in a huge home and had lost all their friendships and was isolated, or had a somewhat middle-class lifestyle but with amazing friends, happy, healthy, most people would choose the latter. And I thought that was a good way of visualizing what you've explained. Like, yes, money fixes a lot of things, but it doesn't fix it's hard to – there's a few things money cannot buy, and it's mental health and general health, which kind of sucks.
Yeah.
It'd be nice.
And I'll just encourage people, with your investing, change your mindset. A year on year, 6-10%, it's not going to be life-changing. Let's just have diversified investments that we're parking money for the you of tomorrow. So do the you of tomorrow a favor today. That's all you can do with investing.
I like that. I want to sort of slightly shift gears now towards FIRE, financial independence, retire early, because you've been speaking on, this idea of parking your money for the future. What's Glen's view on FIRE?
Yeah, so my view, when at first, you don't hear of it much anymore.
Really?
Oh, I don't.
Maybe we have different algorithms.
Probably. My view is the traditional FIRE, and I've met people who've done the traditional FIRE, saved aggressively early in their career, amassed enough wealth to be work optional. All but one person that I've met goes on to start their own business and do their own thing.
All but one. So everyone.
Except one person that I met.
Okay. Oh.
Because they're 35 or whatever, and they've just retired, and they do some charity work. They like gardening, all that. Most people need a little thing in our life called purpose, most of us. And my view is, why slug out your guts? And this is where all these variants going, fat fire and coast fire and flamingo fire and I made a joke up once. There's a new fire called forklift fire, where life goes up and down. It's like a forklift. And I said that taking the piss, and someone thought it was a real thing. I'm really interested in Glen, like in the forklift fire.
Have you heard of Greg Fire?
No.
Have you watched Succession?
Yeah. The last series, I turned off. It was just round in circles.
Well, don't give me any spoilers because I've just started.
Yeah.
But do you know the guy Greg, the normal one who's the skinny tall guy?
Yeah.
He's like the nephew of...
Oh, yeah. The awkward nerdy guy.
Yeah. And in one of the episodes, he goes, oh, well, I'll be fine. I get $5 million. And then everyone's like, oh, no, $5 million's a nightmare, Greg. Like, it's not enough to live off. So there's Greg Fire, which is retiring with $5 million.
So my whole thing was, and there's a dude in Australia who's got a FIRE podcast. He's actually said on the record, I went too hard saving. I didn't live enough. I'm now doing my own thing, working my own business. So my whole philosophy was like, why slug away? Because you've got to build the capital yourself.
Yes.
And that's a transfer of human capital from your job and investing and accruing wealth, and do that for 10 years, 15 years.
Mm.
My vibe is, why not just change something so you don't hate your life and just live how you're going to live, because it's okay to still work.
Yes.
So I've been toying around with, and maybe we need to co-author a book together. That'd be fun one day.
To fire or not fire?
No, I want to change the vibe. Financial independence, retire early, around this time independence. Retired now. Or because I think the whole thing is that I'm doing life on my own terms and I've got control over my life.
I get what you mean. I've never thought of it this way because I have a different view. I like the idea of FIRE. A lot of my goals, like when I was working as an optometrist, between patients, I would read like Your Money or Your Life or other FIRE books and follow, Mr. Money Mustache, like real old school FIRE people. And I liked the idea of, well, actually, I do want to sacrifice 5-10 years and then be set for the rest of my life. But I think it came from a fear of it can all go away. You know, some people grow up with not a lot and then a lot comes and then it goes away. And watching that happen to other people, I was like, I don't want that to happen to me. I want to almost create like my own trust fund where there'll always be a little bit coming in. But I do agree with you. The closer I get to FIRE, the more I realize I will, because everyone would say to me, you won't stop working. And I was like, you don't know me.
Yeah.
I'm going to be by a beach forever. But the closer I get to it, the more I'm like, oh, no, I actually will keep working because I enjoy it. And what I wanted was the freedom of being able to say, like, screw you, I'm going to leave whatever this room situation job. But I've met people like my partner or some friends I have who have very flexible jobs and they love their work and they'll never retire. To them, work is the purpose.
Well, it's like it goes back to they're living a life they don't hate.
Yeah.
They're going to a job they don't hate. We all have bad days.
Yeah.
But I honestly think it's, you know, call me old-fashioned, but like –
what are you going to say?
I don't know. Yeah.
It's never a good thing.
When I do a preposition, it's scary. No, but it's like all these people online doing FIRE and all this stuff.
Me?
Yeah, go for it. Let me know when you have kids, how those plans change.
Like the cost of kids?
Yeah.
Yeah. But you can account for it.
You could.
You send them to public school.
Yeah. But I think also I'm at the stage like do what you want. You ask me my opinion. I just think why do something for years on end that you don't love?
Yes.
Sure, if you loved your job, you paid well. And the people that are really fired that I know have had really good incomes.
Yes.
Like 350, 400K income. Yeah, we save 50% of our income. Oh, I bet you do.
Yeah, absolutely.
I could live off 150 grand as well. Like, I bet you do. So
totally agree.
I think it's just have a plan for your life.
I agree.
If that plan changes, awesome. But if you keep the fundamentals in the background, live on less than you earn, be a generous giver. Might be hard for some fireys to be financially generous. Might be, might not be, don't know.
Do you hate fire people, Glenn?
I hate the zealots.
What does that mean?
Like really like throwing it down people's throat.
Yeah.
And yeah.
Maybe that's why our algorithms are different. You've probably just blocked a couple of fires and Instagram's been like, oh, we won't show you this anymore.
Well, I think I just fundamentally, it's not me.
Yeah.
I'm not a frugal person. I'm not going to stick at something that I don't love. And just looking in, people that have fired have ended up, oh, now I've fired, I can start my own business. I'm like, why don't you just do that 10 years ago? It would have been a funner time.
Yeah.
And you probably would have made more money and had more flexibility along the journey.
I like that.
You could wake up dead tomorrow, Sim.
Okay, but I would have – that's not a reason not to fire. That's what the book will be, just us arguing back and forth. This has been a really, really helpful conversation. I really enjoyed this. I wanted to ask you just one last question around – investing in a way that is not too difficult, but something that people find confusing very quickly, short and sweet. Do you think it is smart to put all your money into investing, or should you hold cash outside of your emergency fund that allows you to invest at opportunities?
Yeah.
Okay.
Yeah, but it's like a level. Like if someone's just starting and they've tripped over your podcast or your book, oh, I've got debt, they're not like, it's just not a conversation for them.
No.
But the more you get along with your life, I'm always like, I've got my emergency fund, I've got my investing, my monthly investing, and then I like to be cash heavy for opportunity. Like when that Trump
tariff
thing happened, there was a beep in my office, and that was me backing up the truck because, and that's like different than, I'm not actually timing, like probably am a little bit timing the market, but I saw an opportunity, a 7 and 8% fall. Yeah, I'll put some money in.
Me too. Me too.
So, yeah, I think it's, or, you know, I do the odd little bit of venture capital, if you will.
Yeah.
I don't do it much, but I like to have money for opportunity.
I agree. It's important to mention, like, for you and myself, it's still dollar cost averaging every week or every month. It's still not trying to time the market. But I personally know that, like, at least once every couple of years, like during March 2020, that was another time when the market dropped. I invested, 3 months later it came back. But I sometimes feel guilty of it because I worry, well, this is me kind of timing the market. So I just wanted to get your opinion on it.
Well, I think as well, I'm doing monthly investing anyway.
Yes.
This is just, I saw an opportunity, extra buying time, throw cash at it. I don't, like people are, oh, you catch a falling knife. I'm okay to catch a falling knife when it's a long-term hold.
Yeah.
Okay, you remember, before we finish, before you started Friends That Invest and quit your job.
Yes.
What did I text you?
I don't remember.
About, are you…
I just remember you saying, will you be looking after people's eyes for the rest of your life and like checking glaucoma?
Yes.
Yes.
Yeah, that's it.
Yeah.
So I've created a song for you. Now that you've been away from that for some time, I'll send it to you. You can do what you want with it.
Oh my God.
Staring through lenses all day, helping folks see life in a clearer way. But deep down she knew she could do more. So she packed her charts and walked out that door. From my exams to money chats, trading specs for spreadsheets and stats. Here's a friends that invest better. Been looking at grandma's glaucoma. She's teaching people all around.
What AI app? All right. Okay. What AI app was this? Oh my God, I'm crying. Oh my God.
I'll send that to you.
I bring up that story to so many people when they ask me, well, what was the trigger to quitting and doing this full time? And I said I had a friend / mentor that would just kind of text me and be like, hey, when are you going to stop checking people's glaucoma? Like, how many more old people do you want to diagnose with glaucoma? Maybe it's time to take this full time. I'd be like, oh, I'll do it later. And I think about that often, and I really have to thank you because I don't think I would have stopped doing glaucoma checks. So,
well, you probably would have, but a bit longer down the line. But
Glen, thank you so much for coming on the podcast, for sharing your insights. It's been so helpful. I've really enjoyed it, and I know our listeners are going to really love this. If they want to find more, keep listening, keep the conversation going. I know there's Money, Money, Money on YouTube. Where else can we find you?
Any podcast app or Instagram. But or if you're an Aussie, the Quick Start Guide to Investing. And one thing that's really good in that book, I did, because we talked about, setting a strategy. I've got a downloadable and examples in the book of having your own personal investment constitution. So this is how I set my investments. This is when I rebalance. And money, money, money on podcast or YouTube. But yeah.
And it's a great book. Please buy it. It's fantastic. Thank you again for writing it.
Thank you so much. Bye.